Josh, I don't have any great insight today. It's going to be a tough show anyway for a couple reasons. What do you think is going on today?
I think keep it very simple. The New York Fed recession probability model just topped the 2020 peak, and it is now at the highest reading since the great financial crisis. You had Q3 GDP come in, revised 3.2%, annualized rate of growth. Most people, even the bulls, do not expect 2023 to be any better than that, and many very rational market participants believe it will be slower. I think the really big story here, though, you got a one-year Treasury at 4.64%. That's your hurdle rate. Like, if you don't have a ton of confidence in whatever you're buying, being able to do better than that, it's a really easy decision to just do that with your money and, quote unquote, let the smoke clear. I'm not saying it's the right strategy. I'm saying that is literally what people are actually doing right now. And it's hard to talk them out of it. And this is where things stand.
We heard from noted investor, hedge fund manager, billionaire David Tepper on Squawk Box this morning. Asked him about his market views. Here's what he said. Listen.
As a hedge fund manager, I'm going to lean short. I'll be short bonds, and I'm not a great. I'm like generally an optimist. I have just the way I just have that sort of lean that way. So it's like I would probably say I'm leaning short on the equity markets. So right now, because I think I think the upside downside just doesn't make sense to me when I have so many people telling me, so many central banks telling me what they're going to do, what they want to do, what they expect to do.
All right, Stephen Weiss, obviously you're good friends with David Tepper. Leaning short, you know his mind. What do you think that means, leaning short?
Yeah, so Dave very rarely makes bad decisions, although I can think of two just in the last few days. The first, taking my wife and I to see Avatar, which was the worst 3 hours I've spent in modern memory. The second was not ordering the eggplant parmesan last night at dinner, even though I know he really wanted it because he told me so. His market calls, however, are rarely wrong. And what he's saying is very simple. He's saying you can't believe the Fed on the way up and then not believe them on the way down. So the inverse, of course, is in rates. So you can't say I'm all in because the Fed's telling me it's okay to buy risk assets and then say, hey, the Fed's wrong. They're going to pivot any minute. So I'm going to try and pick the bottom in the market. So he said many times, his favorite phrase, it is what it is, and it is what it is. Forget the voodoo, who's going to win the Super Bowl? That's telling me what the market's going to do. Or, hey, if we don't hold 3,900 on the S&P, then it's going to go down. If we do, it's going to go up. That's just asinine to look at that when this is the simplest market to navigate that I've seen. As I said in the show last week, it's as simple as when Dave came out and said, when the Fed started cutting rates, buy the market. This is the same decision. So, look, I think that there's a time to protect your capital. There's a time to wait on it. Josh points out an excellent strategy. I agree. I've been buying bonds for a while. It's a gift, and you have tax advantages of buying treasuries. So why would you try to put money in the market? First rule of investing is protect your capital. This is going to last for a while. The Fed's not going to turn and start cutting rates in 3 months. And by the way, 4% is not their target. So forget the fact that inflation peaked and that we may see a lower CPI in the next print. The fact is, the Fed's not giving up until they're comfortable you're going to get to their target of 2%. And we are so far from there, so far, that it's going to be a long, rough road to get there.
Yeah, and we'll bring in Steve Leisman in a moment. Maybe they're going to have to change that target. I mean, 2% just seems like, 1,000 miles away at this point. Shannon, what are you going to advise to your clients?
That's the point, Brian.
Yeah, I know. And Shannon, I'm sure you're getting nervous calls. It's a nervous time. Josh's point about pretty much, I don't want to say 100%, but damn close to it in terms of a recession indicator. What's your best strategy?
Well, I think if you're managing a diversified portfolio, which is what we do, we're really thinking about what happened in November and October and feeling like whether or not we're going to have a Santa Claus rally or not we were sort of indifferent to that coming into December. Our view back in August was that we were going to continue to add to our exposure in other areas outside of equities, and namely bonds, but in some other alternatives as well.